The United States says it wants more critical minerals from trusted allies. Australia is supposed to be one of those allies. But on 14 August, Australia's only silicon metal producer will stop selling into the US after Washington imposed duties of roughly 40% on its exports. Simcoa has supplied about 10,000 tons of silicon metal a year into the US market. The company says the new tariff burden makes that business commercially impossible. It's awkward timing. Less than a year ago, Australia and the United States signed a $4.6 billion critical minerals agreement designed to strengthen supply chains and reduce exposure to China. Silicon metal sits directly inside that problem. It's used in aluminium alloys, silicon chemicals, electronics, and solar manufacturing. The United States already imports it because domestic production doesn't meet demand. Now, if you want practical analysis of how geopolitics is reshaping trade, investment, and international business, subscribe to the channel. That's what I cover here each week. Simcoa itself isn't big. It produces just over 52,000 tons a year in Western Australia and employs just over 200 people. Its strategic value comes from the market structure around it. China produces about 2/3 of the world's silicon metal. Australia only contributes a small share, but it is one of the few reliable suppliers operating inside the US alliance network. The US Department of Commerce found that Simcoa had sold silicon below fair value and benefited from Australian government subsidies. It imposed a 6% anti-dumping duty and a 32.5% countervailing duty. Simcoa disputes those findings. The company's response is commercial, not political. It's leaving. It will redirect product towards Europe, Southeast Asia, and India, where it sees growing demand. US manufacturers will still need silicon. Domestic production may expand, but new industrial capacity takes years to finance, permit, and build. Now, in the meantime, buyers will source material from whatever suppliers can meet their price, volume, and quality requirements. And that creates a problem for US industrial strategy. Washington is spending billions trying to diversify strategic supply chains away from China, while parts of its trade regime can simultaneously make allied supply less competitive. For Aussie companies, there is a clear commercial implication. A strategic partnership between governments doesn't guarantee market access. Companies still have to price regulatory risk, trade remedies, and policy inconsistency into decisions about where they invest, where they sell, and which markets they rely on. Simcoa has already made that decision. The United States is no longer part of its strategy.